Hey, this is Harry, your host. So, something just happened at the Canadian border that has Coca-Cola, PepsiCo, and Nestle executives in emergency meetings. I'm looking at this right now, and when I first read the documents, I had to check 3 different sources because it seemed too dramatic to be real. On February 7th, 2026, the Canadian government under Prime Minister Mark Carney signed into law the Great Lakes Protection Act. This isn't just another environmental regulation. This is Canada effectively shutting off the tap on water exports from the Great Lakes, a source that contains 21% of the world's surface fresh water. Wait, it gets worse. American corporations have been extracting millions of gallons annually under what was essentially a gentleman's agreement dating back to the 1909 Boundary Waters Treaty. That treaty was designed to prevent disputes over shared waterways, but it never anticipated the scale of commercial extraction we're seeing today. Now, that agreement is dead. And the economic implications, we're talking about nearly $890 billion in annual economic activity that depends on Great Lakes water. By the end of this video, you're going to understand why this isn't just a trade dispute. It's a preview of the resource wars that will define the rest of the 21st century. Let me show you what nobody else is connecting. To understand what's happening now, we need to rewind to what's been building for decades. The Great Lakes aren't just big. They're the largest group of freshwater lakes on Earth by total area, covering roughly 94,250 miles. But here's what changes everything. These lakes have been dropping. Lake Michigan-Huron hit near record lows in 2013, sitting 29 in below long-term averages. Now, what nobody talks about is why this matters economically. The Great Lakes support 1.3 million jobs directly through industries like shipping, manufacturing, and agriculture. Another study found that Great Lakes restoration efforts alone generate $2 in economic benefit for every $1 invested. Meanwhile, the American West has been facing its own water apocalypse. Lake Me, the largest reservoir in the United States, dropped to just 27% capacity in 2022. The Colorado River, which supplies water to 40 million people across 7 states, has been overallocated for decades. States have been drawing more water than the river actually contains. Here's where it gets complicated. Starting around 2015, American politicians began floating ideas about diverting Great Lakes water to the parched Southwest. These weren't fringe proposals. We're talking about congressional representatives from Arizona, Nevada, and California publicly suggesting pipeline projects to move Great Lakes water westward. Former President Trump himself mentioned the idea multiple times during campaign rallies in 2023-2024, calling it just common sense to redirect water from the north to where it's needed. Canada heard all of this, and they started doing the math. Here's what I'm about to show you. This is the part that kept me up last night when I was researching this. Let me show you exactly how the extraction system worked, because this is what Canada just shut down and why corporations are panicking. Nestle Waters alone was extracting approximately 1.1 million gallons of water per day from a single well in Michigan and paying just $200 per year for the permit. Let me break down what that means economically. They were paying roughly 0.25 per 1,000 gall. They would then bottle that water and sell it for approximately $1.50 per liter at retail. That's roughly $5,678 per 1,000 gallons. That's a markup of over 11 million % on the raw material. Wait, it gets worse. The beverage industry as a whole uses approximately 1.39 L of water to produce every liter of finished product. Coca-Cola's operations in the Great Lakes region process billions of gallons annually. PepsiCo has 38 manufacturing facilities across the Great Lakes states. These facilities were built on a simple economic assumption. Water is essentially free. It's what economists call an externality, a cost that doesn't show up on the corporate balance sheet because it's absorbed by the environment and the public. Now, what nobody's talking about is the infrastructure lock-in. These companies have invested billions in facilities, supply chains, and distribution networks specifically designed around Great Lakes water access. Coca-Cola's bottling facility in Ontario, Canada, processes over 500 million liters annually. You can't just pick up a bottling plant and move it. You can't easily switch water sources without massive quality control issues. The mineral content, the pH levels, these affect taste profiles that brands have spent decades establishing in consumer minds. This is the part where the economics gets really interesting. When Canada passed the Great Lakes Protection Act, they didn't just ban exports outright. They created a tiered system, complete ban on bulk water exports and diversions outside the Great Lakes Basin. 0.0505 per gallon tax on water used for bottled beverages destined for export. Additional permits required for any extraction over 50,000 gallons per day. Revenue dedicated to Great Lakes restoration and indigenous water security projects. Let me show you what this means in real numbers. If Nestlé continued extracting 1.1 million gallons per day, and all of it was for bottled export, they'd now pay $55,000 per day. That's over $20 million per year instead of $200. But that's not even the real story. The real story is that the law gives Canada the power to reduce or revoke permits entirely if lake levels drop below certain thresholds. It's a mechanism that puts ecological limits above corporate profit, and that's something American capitalism hasn't seen in generations. Here's where this situation gets into territory that I found genuinely shocking when I started connecting the pieces. The United States and Canada share the longest international border in the world, 525 bit of it undefended. Canada is the largest trading partner of the United States with $718.4 billion in goods and services traded in 2023. For over a century, this relationship has operated on the principle of mutual benefit and relative equality. But the Great Lakes Protection Act has exposed a fundamental shift in leverage that most analysts are missing. Now, what nobody's talking about is the geographic reality. The Great Lakes Drainage Basin covers about 94 of those 250 square miles in the US and 36,000 square miles in Canada. But here's the critical detail. The choke points are Canadian. The St. Lawrence Seaway, the primary outlet for Great Lakes shipping, flows entirely through Quebec before reaching the Atlantic. This carries $35 billion in cargo annually, supporting 237,000 jobs across both countries. Niagara Falls, the connection between Lake Erie and Lake Ontario, sits on the Canadian-American border with Canada, controlling the larger flow on their side. The United States cannot simply take Great Lakes water the way it might threaten to take oil in the Middle East. The infrastructure doesn't exist, the geography doesn't favor it, and any attempt to build such infrastructure would take decades and require Canadian cooperation at multiple points. Here's where it gets complicated. The 2006 Great Lakes St. Lawrence River Basin Water Resources Compact already bans diversions of water outside the basin by U.S. states. This was signed by 8 U.S. states and 2 Canadian provinces. But that compact has a critical weakness. It governs state-to-state diversions, not commercial extraction and bottling. Companies found the loophole. If you bottle the water, it's no longer classified as a diversion under the compact. It's a commercial product. That's how Nestlé and others operated for years, technically complying with the letter of the law while violating its spirit. Canada's new act closes that loophole entirely on their side of the border. And because approximately 30% of the Great Lakes water volume sits in Canadian territory, this gives them significant control over the system. What changes the whole picture is this. American politicians have responded with threats. Former President Trump called the act an act of economic warfare and suggested that the U.S. should reconsider our entire trade relationship with Canada. Republican senators from Great Lakes states have introduced legislation to impose tariffs on Canadian hydroelectric power exports in retaliation. But Canada isn't backing down. Prime Minister Carney stated publicly, "Water is not a commodity. It is life itself. We will not negotiate the survival of our ecosystems for corporate quarterly earnings." This is unprecedented rhetoric between these two countries. We're watching the polite diplomacy of the 20th century collapse under the weight of 21st century resource scarcity. Let me show you the economic cascade that's already starting, because the stock market is beginning to price this in, and most investors haven't figured out why yet. Within 48 hours of the act's passage, beverage industry stocks showed immediate volatility. Coca-Cola dropped 2.3%, PepsiCo fell 1.8%, and Nestle's shares declined 3.1% on European markets. This might seem small, but we're talking about a combined market cap of over $600 billion. A 2 to 3% drop represents approximately $15 billion in shareholder value evaporating in 2 days. Wait, it gets worse. The beverage industry is just the visible tip of this iceberg. The Great Lakes support 56 steel mills across the region, which require massive water volumes for cooling and processing. These facilities produce approximately 30% of U.S. steel output. Agriculture in the Great Lakes Basin generates $7 billion annually in crop production and $2 billion in livestock. The basin contains over 53,000 farms, many of which use Great Lakes water for irrigation, either directly or through groundwater systems connected to the lakes. While Canadian restrictions don't directly affect U.S. agricultural water use, the precedent being set creates uncertainty in long-term planning. Now, what nobody's talking about is the insurance industry response. I had to read the industry reports 3 times when I first saw them. Major reinsurance companies, the companies that insure insurance companies, are now classifying water access disputes as a material risk factor for businesses in the Great Lakes region. Swiss Re, one of the world's largest reinsurers, published a February 2026 report stating that cross-spur water policy changes represent an emerging systemic risk to North American industrial stability. What this means in practice, insurance premiums are going up for any business whose operations depend on Great Lakes water. Some policies now include specific exclusions for losses related to governmental water access restrictions. Here's what changes the whole picture. Companies are being forced to make billion-dollar decisions right now about their future in the region. Coca-Cola announced in early February 2026 that they're evaluating our long-term production strategy in light of changing regulatory environments. That's corporate speak for we might have to close plants and lay people off. Nestle has already announced the closure of their Ice Mountain bottling facility in Ontario, Canada, affecting 120 jobs directly. But here's the economic paradox that's emerging. While some operations are shutting down, others are expanding. Companies producing water treatment technology, desalination equipment, and water recycling systems are seeing investment boom. Xylem Inc., a water technology company, saw its stock price increase 8.7% in the week following the act's passage. Investors are beginning to understand that water scarcity isn't a problem to be solved. It's a market to be exploited, and that realization is driving capital toward companies that can profit from scarcity rather than abundance. This is the part that kept me up at night when I was putting this together because the Great Lakes Protection Act isn't happening in a vacuum. It's happening against a backdrop of accelerating climate change that makes the whole situation exponentially more urgent. The Great Lakes region has warmed by approximately 1.66 degrees here since 1951, with winter temperatures increasing even faster at about 2.7 degrees. This creates a paradoxical situation. Warmer temperatures mean more evaporation from the lake surface, but changing precipitation patterns mean less reliable recharge from rain and snowmelt. Lake Superior's average water temperature has increased by 4.5 degrees out since 1979, faster than the air temperature around it. Warmer water holds less dissolved oxygen, which affects aquatic ecosystems, but it also increases evaporation rates. One study projects that if current warming trends continue, the Great Lakes could lose between 5 to 15% of their volume by 2050. Now, what nobody's talking about is the ice cover feedback loop. The Great Lakes used to freeze significantly during winter, which reduced evaporation during the coldest months. Ice cover on the Great Lakes has declined by 71% since the 1970s. Less ice means more open water during winter, which means more evaporation year-round, which means lower lake levels, which means less water available for everything we've been discussing. Meanwhile, the American West faces its own accelerating crisis. The mega drought affecting the Southwest is now in its 23rd year, the worst in 2,200 years. According to tree ring studies, climate models project that the Colorado River Basin could see a 10–30% reduction in stream flow by mid-century. Here's where it gets complicated. Some might wonder if climate change is affecting the Great Lakes too. Why is Canada restricting exports now? The answer is that Canada is reading the same climate projections and making a calculated decision. Protect what we have now while we still can. The Canadian government's own climate assessment projects that the Great Lakes region will see more variable precipitation, meaning more extreme floods and droughts with less predictable water availability overall. In that context, allowing unlimited corporate extraction today seems increasingly reckless. The act is essentially climate adaptation policy disguised as trade regulation. So, where does this actually go? I want to walk through the 3 most likely scenarios playing out over the next 5 to 10 years, because sources I've been following are now confirming that we're at a genuine inflection point. In this path, the United States imposes retaliatory tariffs on Canadian goods, particularly targeting sectors like lumber, aluminum, and hydroelectric power. Canada responds with its own countermeasures. The USMCA trade agreement, which replaced NAFTA in 2020, comes under strain. Some legal experts argue that water is explicitly excluded from USMCA provisions, meaning Canada's actions are within their rights. But trade wars aren't about legality. They're about leverage. In this scenario, both economies suffer. But companies most dependent on Great Lakes water face the worst outcomes. Manufacturing jobs decline across the Rust Belt. Political tensions increase. This is the outcome most mainstream analysts expect. The US and Canada return to the negotiating table. A modified agreement emerges that maintains some restrictions on bulk exports and diversions, creates a graduated tax system less punitive than the current 0.05 to gallon, establishes joint US-Canada oversight body to manage lake levels, includes sunset clauses that automatically adjust based on lake level thresholds. The International Joint Commission, which already manages some boundary waters issues, would likely play a central role. In this scenario, corporations get some relief. Canada maintains its sovereignty over resource management, and both countries avoid a full trade war. But the fundamental dynamic has still shifted. Water is now explicitly recognized as a limited managed resource rather than an infinite free good. This is the scenario I find most fascinating and the one that might be hardest for American audiences to accept. In this path, Canada's restrictions simply stick. American corporations adapt by relocating bottling operations outside the Great Lakes region entirely, investing billions in water recycling and efficiency technology, shifting to alternative water sources like desalination, expensive but increasingly viable, passing costs to consumers through higher prices. In this scenario, the price of bottled water in North America increases by 15 to 30% over 5 years. Premium water brands become even more premium. Cheap bottled water becomes less cheap. Some companies exit the market entirely, but the broader economic structure adjusts. Just as carbon pricing eventually became normalized in many markets, water pricing becomes the new reality. And crucially, Canada's move inspires other water-rich regions globally to assert similar sovereignty over their resources. Climate change doesn't wait for negotiations. Lake levels will continue to fluctuate. Droughts will intensify. And every year that passes makes the political calculus harder for Canada to reverse course, because every year that passes makes the ecological case for protection stronger. So, here's what I want you to take away from this. The Great Lakes Protection Act isn't really about water. It's about power. It's about who gets to decide how we use the fundamental resources that keep industrial civilization running. For a century, that decision-making power rested with corporations. They built business models on the assumption that nature was free, that water, clean air, stable climate. These were just background conditions that would always be there. Canada has shattered that assumption. They've said, no, the water isn't free. The ecosystem has limits, and we're going to enforce those limits even if it costs corporate profits. Now, I'm not here to tell you whether that's good or bad. Different perspectives exist. Some see this as responsible environmental stewardship, a government finally putting ecological sustainability ahead of short-term economic gain. Others see it as protectionist policy that will harm workers, disrupt supply chains, and damage the integrated North American economy that both countries depend on. Some indigenous communities in the Great Lakes region have praised the act as long overdue recognition of water as sacred and finite. Others worry about economic impacts on their communities that depend on manufacturing jobs. What's undeniable is that this represents a fundamental shift. Resource nationalism is coming to North America. The free market in natural resources, the assumption that capital should move freely to extract and exploit wherever it wants, is being challenged at the highest levels. And the Great Lakes are just the beginning. We're going to see similar conflicts over lithium deposits, rare earth minerals, arable land, and yes, water resources across the globe. The age of abundance is over. We're entering the age of allocation and the question of who gets to do that. Allocating markets, governments, communities is going to define the economic and political conflicts of the next 50 years. I want to know what you think. Are you in the Great Lakes region? Have you noticed changes in water policy where you live? Do you think Canada is right to restrict access, or is this going to cause more problems than it solves?